Hello everyone, welcome to the 63rd episode of me learning how to trade in Forex. So in the last episode we went through how to trade with Guppy Multiple Moving Average. We made notes throughout all of this, basically separating, setting up the Guppy Multiple Moving Average with two groups. We've got the short term and the long term group. How to identify trend strength and trend reversals, identifying lack of trends, what the buy and sell signals are when using the Guppy multiple moving average, and now we paused at the GMMA compression breakout strategy. So let's continue off where we paused at, and your boys also fixed the spellings now, so they actually work. Oops. So where was I? I am right here. So the GMMA compression breakout strategy. The moving averages also act to support resistance levels. When compression of both groups of moving averages occurs on the same candlestick, this could indicate an overall trend change. Here's the trade setup. Trade setup. Look for a candlestick in which the high and low pierce through all 12 moving averages. So all 12, that's both the short term and the long term ones. Then place a buy stop order above the high and sell stop order below the low of the candlestick. Once filled, make the opposite stop order. That wasn't filled, your initial stop loss level. So once filled, make the opposite stop order that wasn't filled, the initial stop loss level. Trail or stop at the prior candlestick's low if long, or high if short, until stopped out of position. Trail your stop at the prior candlestick's low if going long, or high if going short, until stopped out of position. Okay, here's an example. So we can see this candlestick here is where all 12 of the moving averages are going to pass through. Place a buy stop order at the above the high, so above that top of the wick there, and sell stop order below the low of the candlestick. Yep. In the chart above, both groups of exponential moving averages have become tightly compressed. Notice how the last candle opened below all moving averages and managed to close above all moving averages. Yep. So the moving averages can basically go through the middle of it. This can be interpreted as a price being able to close above a resistance level with the compressed exponential moving averages. Set a buy stop order above the candle's high and a sell stop order below the low. Yep. So buy stop order triggered. Place the initial stop loss order. In the next candle, the right price rises, which triggers a buy stop order. The previous sell stop order now becomes your initial stop loss. Price continues to rise. Whenever a candle makes a new high or low, you can trail stop loss and use this as a new stop loss until you get stopped out. New high or low, so move your stop loss like here, and then here, or whenever, whichever one's the highest. I like to present here, 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 like that. Okay. It uses a new stop loss until you get stopped out. So until the stop drops below whatever the low was. Limitations of the Guppy Multiple Moving Average. The main limitation of the Guppy is that it's a lagging indicator. Main limitation of Guppy is that it's a lagging indicator. This is because the Guppy consists of exponential moving averages, and we've mentioned in the previous lesson, exponential moving averages are lagging indicators. As it consists of exponential moving averages which are lagging indicators. A lagging indicator gives the signal after the trend has started. Lagging indicator gives the signal after the trend has started. Gives a signal after the trend has started. This means that waiting for the exponential moving averages to cross over can sometimes result in an entry or exit that is too late, as the price has already moved significantly. So meaning waiting for the exponential moving averages to cross over can sometimes result in an entry or exit which is too late, as the price has already moved significantly. With any trend following indicator, you're always going to end up getting into a trade after the trend has already started, and end up getting out of the trade after the trend has already ended. With any trend following indicator, you're always going to enter the trade late, enter the trend after it has started, and exit after it has finished. That's why it's called a trend following indicator. You don't try to predict when a trend will start, you wait for it to form first and then you simply follow it. Also, all moving averages are also prone to whipsaws. A whipsaw occurs where there is a crossover which signals an entry, but instead of price moving in the expected direction, it moves back to the opposite direction, causing the exponential moving averages to cross again, which signals an exit and realized loss. All moving averages are prone to whipsaws. So a whipsaw occurs where there is a crossover which signals an entry. However, instead of the price moving in the expected direction, it moves back in the opposite direction. So basically like a fake out then, maybe, causing the exponential moving averages to cross again. Which signaling an exit, which is a realized loss. Summary: the Guppy Multiple Moving Average is a trend following system. Guppy Multiple Moving Average is a trend following system. Trading with the trend helps you win more than lose. The Guppy can help you visualize both scenarios of either a trend reversal or a trend continuation. Guppy can help you visualize both scenarios of either a trend reversal or a trend continuation. Although a simple indicator, the Guppy system only works best when the price is in a clear trend. Guppy only works best when the price is in a clear trend. There is no technical indicator that is right all the time. If you find one, please let us know. Here are some tips for trading with Guppy. Trade in the direction of the long-term group of exponential moving averages. Guppy tips. So trade in the direction of the long-term exponential moving averages. The degree and nature of the separation in the long-term group of exponential moving averages define long-term trend strength. The degree and nature of separation in the long-term group of exponential moving averages define the long-term trend strength. The degree and nature of separation in the short-term group of exponential moving averages define a short-term market sentiment. The degree and nature of separation in the short-term group of exponential moving averages define the short-term market sentiment. When both groups are moving in the same direction, both trending up or down, current market sentiment and the overall trend are in agreement. When both groups are moving in the same direction, current market sentiment and overall trend are in agreement. A compression of both groups at the same time indicates a potential for a trend change. A compression of both groups at the same time indicates the potential for a trend change. Summary using moving averages. Using moving averages. There are many types of moving averages. The two most common types are simple moving average and exponential moving average. Simple moving average are the simplest form of moving average, is slow but smooth. Exponential moving averages put more weight on recent prices, which means they place more emphasis on what traders are doing now. Simple moving averages are slow but smooth. Exponential moving averages put more weight on recent prices. It's much more important to know what traders are doing now than to see what they did last week or last month. Placing more emphasis on what traders are doing now. More important to know what traders are doing now than to see what they did last week or month. Simple moving averages are smoother than exponential moving averages. Yep. Longer period moving averages are smoother than short period moving averages. Averages are smoother than exponential moving averages. Long-term moving averages are smoother than short-term moving averages. Should be periods, right? Yeah, long period. Using the exponential moving average can help you spot a trend faster, but it's prone to many fake-outs. Exponential moving averages can help you spot a trend faster, but is more prone to fake outs. Simple moving averages are slower to respond to price action, but will save you from spikes and fake outs. However, because of their slow reaction, they can delay you from taking a trade and may cause you to miss some good opportunities. Delay you from taking trade. You can use moving averages to help you define the trend, when to enter, and when the trend is coming to an end. Moving averages can be used to define the trend, when to enter, and when the trend is coming to an end. Moving averages can be used as dynamic support resistance levels. Moving averages can be used as dynamic support and resistance levels. One of the best ways to use moving averages is to plot different types so that you can see both long-term movement and short-term movement. Plotting different types of moving averages allows you to see both the long-term and short-term trend, right? Oh no, movement. Price movement. You got all that? Why don't you open up your trade charting software and try popping up some moving averages? Remember, using moving averages is simple. The hard part is determining which one to use. That's why you should try them out and figure out which best fits your style of trading. Maybe you prefer a trend following system, or maybe you want to use them as dynamic support and resistance. Whatever you do, make sure you read up and do some testing to see how it fits into your overall trading plan. Okay, how to use Bollinger Bands. How to use Bollinger Bands. Congratulations on making it to the 5th grade. Each time you make it to the next grade, you continue to add more and more tools to your trader's technical analysis toolbox. What's a trader's toolbox, you ask? Simple, TA. Let's compare trading to building a house. You wouldn't use a hammer on a screw, right? Nor would you use a buzzsaw to drive in nails. There's a proper tool for each situation. Just like in trading, certain technical indicators are best used for particular environments or situations. So the more tools you have, the better you can adapt to the ever-changing market environment. True. Or if you want to focus on a few specific trading environments or tools, that's cool too. It's good to have a specialist when installing your electricity or plumbing in a house, just like it's cool to be a Bollinger Bands or moving averages specialist. There are a million different ways to grab some pips. For this lesson, as you learn about these indicators, think of each as a new tool that you can add to that toolbox of yours. You might not necessarily use all these tools, but it's always nice to have plenty of options, right? You might even find one that you understand and comfortable enough to master on its own. Now, enough about tools already, let's get started. Bollinger Bands. Bollinger Bands, a technical indicator developed by John Bollinger, are used to measure market's volatility and identify overbought or oversold conditions. Bollinger Bands is a technical indicator used to measure a market's volatility and identify overbought or oversold conditions. That's John Bollinger himself. Basically, this little tool tells us whether the market is quiet or whether the market is loud. When the market is quiet, the bands contract, and when the market is loud, the market bands expand. When the market is quiet, the bands contract. When the market is loud, the bands expand. Look at the chart below. The Bollinger Bands BB is a chart overlay indicator, meaning it's displayed over the price. So the bands are contracted here and they get wider, so they expand. Shh, quiet, making some loud noises. Notice how when the price is quiet, the bands are close together. When the price moves up, the bands spread apart. The upper and lower bands measure volatility or the degree in the variation of prices over time. So upper and lower bands measure volatility or the degree of variation of prices over time. Because Bollinger Bands measure volatility, the bands adjust automatically to changing market conditions. That's all there is to it. Yes, we could go on and bore you by going to the history of the Bollinger Bands, how it's calculated, the mathematical formulas behind it, and so on and so forth, but we really didn't feel like typing it all out. Okay, fine, we'll give a brief description. What are Bollinger Bands? Bollinger Bands are typically plotted as 3 lines. Bands typically plotted as 3 lines. An upper band, a middle line, a lower band. The middle line of the indicator is a simple moving average. Oh, right. Simple moving average. So this is like the, I want to say the envelope. It's like this sort of thing here. No, it's not actually. Moving average are used to confirm trend, identify overbought and oversold conditions. Oh, well, okay. Kinda is maybe. Most charting programs default to a 20 period, which is fine for most traders, but you can experiment with different moving average lengths after you get a little experience applying Bollinger Bands. The upper and lower bands by default represent 2 standard deviations above and below the middle line moving average. Upper and lower bands represent 2 standard deviations above and below the middle line. If you're freaking out because you're not familiar with standard deviations, have no fear. The concept of standard deviation is just a measure of how spread out numbers are. If the upper and lower bands are 1 standard deviation, this means that above about 68% of the price moves that have occurred recently are contained within these bands. If the upper and lower bands are 2 standard deviations, this means that about 95% of price moves that have occurred recently are contained within these bands. You're probably falling asleep. Let's hit you with an image. Standard deviation. So this is 1 standard deviation of 68%, 2 standard deviations of 95%, 3 standard deviations of 99.7%. As you can see, the higher the value of standard deviations you use for the bands, the more prices the bands capture. You can try out different standard deviations for the bands once you become more familiar with how they work. In all honesty, to get started, you don't need to know most of this stuff. We think it's more important that we show you some ways you can apply the Bollinger Bands to your trading. Now, note, if you really want to learn about the calculation of Bollinger Bands, check out John's book, Bollinger on Bollinger Bands, or check out our lovely Forexpedia page on Bollinger Bands. Oh, Forexpedia. Damn, I like that sound of that name. Forexpedia. Okay, the Bollinger Bounce. one thing you should know about Bollinger Bands is that the price tends to return to the middle of the bands. Price tends to return to the middle of the Bollinger Bands. That is the whole idea behind the Bollinger Bounce. By looking at the chart below, can you tell us where the price might go next? So it should go like here, right? Somewhere around here. Yeah. If you said down, then you're correct. As you can see, the price settled back down towards the middle area of the bands. What you just saw was a classic Bollinger bounce. The reason these bounces occur is that the Bollinger Bands act like a dynamic support resistance levels. Bollinger Bands act as dynamic support and resistance levels. The longer the time frame you're in, the stronger these bands tend to be. Many traders have developed systems that thrive on these bounces, and this strategy is best used when the market is ranging and there is no clear trend. Right, okay, so this is where you don't really need a trend for this strategy to work, unlike the simple moving averages we saw, or the exponential moving averages we saw, where we actually need to or the Guppy Multiple Moving Average, where you need a clear trend for it to work properly. This is where so the longer time periods you're in, the stronger these bands tend to be. Many traders develop systems that thrive on these bounces, and the strategy is best used when the market is ranging. Bollinger Bands are best used when the market is ranging and there is no clear trend. You only want to trade this approach when price is trendless, so be mindful of the width of the bands. Be mindful of the width of the bands. So, because isn't it contracting and expanding? So if there is a trend, or if there is a when the market's quiet, the bands are close together. When the market is loud, the bands spread apart. So if the market is really volatile, then the bands spread apart. But if it's not so volatile, then the bands contract so closer together. So therefore be mindful of the width of the bands, as they determine whether the market is trending or not trending. Whether the market is volatile or not. Avoid trading the Bollinger Bounce when the bands are expanding. Avoid trading the Bollinger Bounce when the band is expanding, because this usually means that the price is not moving within a range but in a trend. Let's call it trending or not. As this usually means the price is not moving within a range but trending. but in a trend. Instead, look for these conditions when the bands are stable or even contracting. Or when the bands are stable and or contracting. Now let's look at the way to use Bollinger Bands when the market is trending. So, okay, Bollinger Squeeze. The Bollinger Squeeze is pretty self-explanatory. When the bands squeeze together, it usually means that a breakout is getting ready to happen. When Bollinger Squeeze. When bands squeeze together, usually means that a breakout is getting ready to happen. If the candles start to break out above the top band, then the move will usually continue to go up. If the candles start to break out above the top band, then the price move will usually continue to go up. If the candles start to break out below the bottom band, then the price will usually continue to go down. If the candles start to break out below the bottom band, then the price move will usually continue to go down. Candles break the upper band, bands squeeze together, candles break the upper band, so it's usually go up. Look at the chart above, you can see that band's squeezing together, yep. So it goes from this width to this width. The price has just started to break out the top band here. Based on this information, where do you think the price will go? Price shoots up. If you said up, you are correct again. This is how a typical Bollinger Squeeze works. This strategy is designed for you to catch a move as early as possible. Setups like these don't occur every day, but you can probably spot them a few times a week if you're looking at a 15-minute chart. There are many other things you can do with Bollinger Bands, but these are the two of the most common strategies associated with them. Go ahead and add the indicator to your charts and watch how the prices move with respect to the three bands. Once you've got the hang of it, try changing up some of the indicator parameters. It's time to put this in your trader's toolbox before we move into the next indicator. Oh yeah, and the bands get wider, so it shows that the market's in a trend now, hence the trend here. Okay. Nah, let's just tidy up our previous section, because I don't want to pause halfway through this. So, so where does it say the Bollinger bounce? The Bollinger bounce is price tends to middle bands. Bollinger bounce. Price tends to middle of the Bollinger Bands. Good photo of this. Okay, What else? Dynamic, yep. Be mindful of the width. The Bollinger squeeze. Okay, I think that looks pretty good. I don't think we've missed anything. So where is the middle line for this actually? Because they said it's plotted as 3 lines, but there's only the upper bounds and the lower bounds. There should be a moving average somewhere like along here, right? But it's not there, so yeah. So there should be like a simple moving average, so it's not even, it's going to be like smooth like this. But if there is no trend, then that means the simple moving average is just going to be flat then. So it'd be like around here, and then at here it will start to go up. But yeah, okay, sure. So I am going to leave this episode here. Thank you all for watching. In the next video we're going to go through how to use Keltner channels. So yeah, I will see you then. Bye bye.